All right. Welcome, everyone, to the all-weather strategy update. My name is Andrew Stotz, and we're going to go through the performance of the all-weather strategies and take your questions, talk about U.S. politics and what's going on in the world. And hopefully, I'll get a lot of great questions from you, which I'll be happy to answer. I'm going to be switching cameras today, so I'm going to be switching from my side view camera at some point to my front view camera. So you get ready for it. I am basically having a nice, delicious Coffee Works espresso. What are you having? Coffee, tea, water, lunch. So I want to welcome everybody here. We have about close to 90 people on the call, and I think we'll have more coming on. But what a great time to discuss about markets and about performance and how to position going into 2025 now that we know that Donald Trump is going to be the next president if he can survive this period. Yes, Pisit Pong says espresso. Way to go. All right. So what are you guys drinking? Make sure to put that in the chat, but also say hello, so I know where you are. I know we also have some people that are attending from around the world. So if you're coming in from another country besides Thailand, make sure to comment in the chat so that I know where you're coming in from. So let's get started. I'm going to share my screen and I'm going to talk about the performance of the strategy. And so I'm going to talk a little bit about performance and then we're going to come back. So let's start with that. Remember, you can ask any question in the chat. I'm happy to get your questions. Remember that our allocation strategies are global, they're long-term, and they're diversified. We're diversifying across asset classes, regions, sectors, and companies. And as always, I like to start by remembering, why are we here? We are here to build wealth over the long term. Now, I see 6 pillars of investing. First, invest in stocks. Stocks have returned much more than bonds and gold over the years. And owning a piece of a company means you get a portion of what that management team creates. Number 2, reduce risk. Avoid overexposure to any single asset by spreading your portfolio across various companies, sectors, countries, and asset classes. And number 3, contribute regularly. Reduce stress by applying dollar cost averaging, consistently investing a fixed amount over time. This takes some advantage of some volatility and likely lowers costs and enhances long-term returns. When I work with my nieces to try to help them to learn how to invest, this is the one thing I missed. I gave them a lump sum and they invested that, but over time, they didn't contribute as much as I had hoped. And contributing regularly is a key to building wealth. Number 4 is stay invested. The king of staying invested is Warren Buffett. In fact, I know my business partner, Alex, is watching this, and we should really replace this picture here with a picture of Warren Buffett because he is the master at staying invested. He stayed invested in his strategy for more than 60 years. So think long-term, be patient. The benefits of compounding happens over decades. Number 5, maintain discipline. Follow your investment plan to avoid acting based on emotions. And finally, number 6, part of what we're doing here is continue learning. Deepen your understanding of investing, stay informed about market dynamics, and refine your strategies by learning from successes and failures. So remember, we create our strategies for decades, but not even a decade is really truly long term. This is me when I was a kid, and this is me when I arrived in Thailand, and this is me when I'm going to be 100 years old. Our aim is to create strategies that perform over many decades. I summarized all of this in my book, How to Start Building Your Wealth, Investing in the Stock Market, which is available either as a book or online. You can get it on Amazon, or you can get the physical book here in Thailand. So our target is to deliver steady returns over the long run. These are the 3 portfolios that we've had. We started with the all-weather strategy. Then we launched the Alpha Focus strategy. And then we launched all-weather inflation guard, the lowest risk strategy. AWS was launched in 2019, and we target 6% per annum return. Alpha Focus was launched in October of 2021, and we're targeting 8% return. And All Weather Inflation Guard launched in July of 2022, and we target 4%. From when we started All Weather Inflation Guard in July of 2022, the strategies are performing almost as expected. So the moderate risk AWS has returned slightly more than the higher risk Alpha Focus, which can happen at times. And All Weather Inflation Guard had the lowest return, but also the lowest volatility. So Inflation Guard is when someone doesn't feel so aggressive in their asset allocations. Now, I've added in world equity into this. Since July 22, all strategies had lower volatility than world equity, but they all underperform world equity because we're not trying to have 100% exposure to world equity. So we are going to miss. We mix asset classes rather than hold pure equity to try to avoid a portion of equity market drawdowns, as you can see right there back in, let's say, August or so, 2022. But it also means that we're going to miss some of the upside. And that's why we target 8% average annual return. Of course, some people say, I want all that upside. Well, then you have to be 100% exposed to equity. But we're trying to capture a portion of that upside, but also manage the volatility of the portfolio. Now, before I go further, let me just go back and let's talk for a minute or two. Hold on one second. So I'm going to switch my camera back over. There we are. So let me just encourage everybody to send in any messages. I'll see them, as well as any questions that you have. We have about 145 people on this call, and I believe it's time for more espresso. So let me have a little sip of espresso before we continue on. Perfect. So I just want to welcome everybody. I see Nat Tina 007. Hi there. And Nuti says, I'm drinking tea. And Mika says, very clear and nice sound quality. Krap Ajan Andrew. And also TT says, hi, Ajan Andrew. I want to welcome everybody here. And please tell us where you are. And if you're coming from outside of Thailand, happy to hear from you. And I see Brookies Leo. Cheers. Yes, that's a cheers to you too. And I see Nok Noi Natanan. Hello from Chiang Mai. In fact, I'm taking my mother to Chiang Mai in a couple of weeks. So let's talk about that. Maybe we should do a little conference for Phenomena in Chiang Mai. That would be fun, and talk about the strategy. So welcome everybody. And I want to encourage you to ask questions. I've just done the intro part of this presentation. And now I'm going to switch back and go back into the presentation, and I'm going to switch my camera. My camera gets a little funky when we do that, but here we are. Now let's talk about, I see Lee Wrigglesworth. Great to see you, Lee. Lee's in the south of Thailand. I haven't been down there in a while. And also Da Kittisak says, greetings from Bangkok, almost end of the year, and it's time to prepare for next year. Exactly. Yeah, Nok Noi. That would be great. Maybe we should do some event in Chiang Mai, huh? UNPY says, hi from Bangkok, just finished lunch. Perfect. Today is my fasting day. It's Monday, so I'm not having any lunch right now. All right, let's continue on. So since we're going to talk about the all-weather strategy, which fell by 0.3%. Since inception, the strategy was up 47.7%. And that's 19.5% above a 60-40 portfolio. Here we can see in October, the strategy was down 0.3%, which was 2.3% above the 60-40 portfolio. Our 25% target allocation to gold did great. And our allocation, 25% allocation to US did okay, while global bonds did poorly. We can see here. Let's look at all-weather Alpha Focus. It gained 0.5%. Here we can see that since inception, the strategy was up 4.3%, And since, and that's 7.9% above a 60-40 portfolio that we tend to measure it against, and 0.4% below world equity, but with a lot less volatility. And so our objective is to try to reduce the volatility as much as possible. In fact, you can see on this chart, in fact, I want to grab my pen here for a second. Let me just grab my pen. Since I'm a teacher, I might as well do a little teaching here. What you can see is that at this point, we can see that all this downside in world equity, we didn't participate in that. Instead, the all-weather alpha focus strategy did go down, but it didn't experience such a brutally painful loss. But that's also going to mean that we're going to miss some of the upside, like right here and right here. But I'm willing, and I know for all of the listeners and viewers out there, what I try to tell everybody is that what I really look for is I want to not go down as much when the market goes down. That's my goal. If I can do that, then it's perfect. So in October 2024, the strategy was up 0.5%, which was 3.1% above the 60-40 portfolio. Our big tilt to gold did great. Our 3% tilt to miners did even better. Our world equity fund outperformed, and our tilts to infrastructure, global bonds, and healthcare were a drag on our performance. Finally, let's look at all-weather inflation guard, which did fall 0.8%. Since inception, the strategy was up 7.7%, which is about 6.6% above a 40-60 portfolio. Now, for those who have the question in your mind, this is our best estimate of after fees. As you can see in the notes, what we say is the benchmarks and the strategy's performance is calculated from the fund's NAV, which is after management fees, but does not consider sales charges like front-end fees. So overall, I would say the performance has been pretty good. The strategy was also experienced much less volatility, and that's really what we're trying to get to with this strategy. Here we can see that the strategy was down 0.8% in October, which was 2.1% above the 40-60, 40% equity, 60% bond portfolio that we're benchmarking against. Global bonds fell in October, and our 5% allocations to gold, financials, and infotech did great. Our world equity fund outperformed, and our 5% allocation to REITs was a big drag, unfortunately, as you can see. But it wasn't such a drag to damage our performance relative. So before I get into the next topic, which is I want to talk about global bonds a little bit, I'm going to talk about global bonds allocations. And I know I've gotten some questions about the bond funds that we use and things like that. So let's have some fun going through different funds that are available in bonds. But meanwhile, just to say hi, ABB's here. Good to see you. Good afternoon, John, Andrew. Welcome to everybody. We have about 170 people on the call, and feel free to submit any questions that you may have. If you have any questions about gold, about election, about allocations, hopefully you do have some questions, and I look forward to hearing those questions. So I'm going to go back into the presentation, and let me do that. I'm going to switch my camera over to the other one, and I'm going to talk a little bit about global bond allocation. So we've gotten questions about our choice of the SCB Globe Fund due to its recent performance, which has been, unfortunately, an underperformance. I'm going to try to take myself out of the screen here. Let's see if we can do that and maximize my, not sure exactly how to do that. Hold on. Let's see. There we go. Okay. So I thought it would be a good time to go into this in a little bit more detail. Let's first look into what we said in September of 2023 when we started using this SCB Globe in our strategies. So we said switching to global bonds from the time money market. In the past, we were owning time money market. In 2020, in March, when COVID hit, we decided to allocate to the time money market instead of global bonds to reduce risk. And in fact, the bond fund that we were using at the time ended up stopping any types of redemptions for a period of time. So we were lucky to get out of that. We've now decided to return to global bonds and move our bond allocation to SCB Global Bond Fund from TMB Treasury money. This is what we said in September of 2023, about a year ago. We analyzed 10 global bond funds and found 3 that were suitable. One was highly correlated with world equity, so we ended up with 2 final candidates. This is what we said at that time. Basically, what we showed was we preferred the SCB Globe as it has more exposure to government bonds versus corporate bonds, which is generally lower risk. So the master fund of SCB Globe, you can see on the right, 60% government. And we were trying to reduce risk with this fund. We weren't trying to pick up corporate returns. Also, you can see the maturity at 7.8 was half of the master fund of the other fund that we were looking at, 15.7. So, as we say, going back in time, we analyzed 10, and basically, these are the 3 that stood out at that time. So, recently, we've been recommended to consider a couple of others, K Global and MFC International Smart Fund. So that's what I'm going to talk a little bit about, is our analysis of this. So let's look at the 5 master funds to see a longer track record of each fund. So remember, these are feeder funds in Thailand, which means that there's a mutual fund set up in Thailand, and the only asset that mutual fund owns is the ETF that's traded, in this case, in the US, and that's their only asset. That is a feeder fund, and therefore the asset or the ETF that they own is what's called a master fund. Remember, when we generally don't allocate to bonds to speculate on the upside, but to diversify and protect capital over time, because as I mentioned in the beginning, we want exposure to equity. We're looking for global bond exposure at a reasonable cost with the best diversification benefits and at a reasonably large fund. So here we can see the 5 different performance of the 5 different funds. We're looking at the underlying assets, and what we've calculated is a correlation. If we were to see a fund, let's say in this case, I'm going to try to grab hold on. If we saw a fund that had a correlation that was up in this area, we would say its correlation is almost 100% positive to equity. There's no diversification benefit. But if we saw a fund that had a correlation that was down at the bottom of this chart, we would say that has a very negative correlation to equity, meaning when equity goes down, this fund goes up. So we would prefer on this chart to be lower rather than higher. We want lower correlation, and preferably below the 0 line. We would love it if we could find negative correlation, which we can't right now. So the first one is based on the lower diversification benefits of the brown line, which is called iSmart. We've decided to eliminate that one because we don't want high correlation. The remaining 4 master funds have offered fairly correlated returns to world equity. So since September of 2023, SCB Globe's master fund has generated the lowest return, as you can see. And that's why people have asked us, what are we doing? And so let's look at this. SCB Globe's master fund times its over and underweighting of the US wrong in first quarter 2024, particularly, which led to underperformance. Bond funds are often active, and active strategies can underperform at times, as we can see here. If we look at the past 6 months, the return of SCB Globe's master fund has been on par. So we see it as one period of time. Hindsight is 2020, and past performance shouldn't be the single selection criteria for any investment strategy. Unfortunately, with feeder funds, you don't get the performance of the master fund due to fees in particular. So you can see the fund that we're buying, the SCB Globe fund, is never going to get the return of the master fund because of fees. Also, funds have cash requirements, like 3 to 5% to handle liquidity. And so that 3 to 5% cash cannot be invested into the ETF by the fund. So there's a drag, or what we call a cash drag. There's also costs to hedging Forex. SCB Globe is currently 95% hedged, and there's a cost to that. And that's the reason why SCB Globe has a return that's slightly below the master fund. During this period, US dollar weakened by about 8% against the Thai baht, so it was better to be hedged. So let's look at KKP Global Unconstrained Bond. It's tilted towards corporate bonds. Well, that's not really what we want. We want to have it tilted more towards government bonds, because we're not trying to pick up a lot of return. We're trying to come up with diversification benefits. So in September of 2023, we explained we prefer SCB Globe as it has more exposure to government bonds versus corporate bonds, which means generally lower risk. All right, so also we can see K Global Bond Fund also has more corporate bonds, and so we're less attracted to that, though that balance is less. So next, let's look at regions. Here we can see that KKP and SCB have less U.S. exposure. Developed markets, Americas is the region where U.S. is. And what we can see here in terms of maturity and duration, only the KKP fund stands out with significantly higher average maturity, which you can see the maturity here. You can see right here is 15.7 years maturity, and duration is about 7.3. Now, truthfully, duration is really what we care about, so it's not as big a difference as what it shows of 15.7, but still we want to be careful about that duration. And here we can see that the management fees and the total expense ratio are not vastly different among the funds. They're about the same. eSpring has the highest front-end fee, and the K Asset Bond has only about 20 million in assets under management. Now, assets under management aren't a huge issue when the underlying ETF that it's investing in, that the feeder fund is investing, is very liquid. But still, why would we want to put some money into that right now? We are careful not to go to funds that have very low assets under management. And finally, we can see all funds are currently hedged between 90 to 100%. So we are kind of comparing apples to apples here. So we think that SCB Globe is a suitable choice for our strategies based upon this analysis that we previously did when we brought it into the strategy, and what we're going to keep it in after reviewing the different alternatives until we find a better alternative. With that said, we haven't found the perfect global bond fund in Thailand. I want a fund that has more negative correlation to the market. We're looking and we're working on a global bond fund strategy. Followers of our strategies will be the first to know if that work results in a new fund. So we are considering constructing a new fund in Thailand that would be a global bond fund that would try to have much lower correlation to our equity position. We're working on that now, and if we can come up with that, we will launch that fund. So the key takeaways are: we generally allocate to bonds to diversify and protect capital over time. We look for global bond exposure with low correlation to world equity. And we prefer more weight to government. We prefer to have more weight in that bond fund to government over corporate bonds, as it's lowering the risk. And from the available funds in Thailand, SCB Globe still looks suitable to us. Unfortunately, it didn't perform that well over a period of time, but it's kind of back to normal at this point. Now, the next section, I want to talk about the US election. Is that exciting or what? But I'm going to switch back and talk to you briefly and remind you, ask any questions that you have. We have 193 people on this call, and hopefully we'll get lots of questions. So feel free to send in any questions. Okay, let's look at this for a second. Patra Win says, good afternoon, Kun Andrew. I have my cold brew coffee. Cheers. That's excellent. I love cold brew. Salaya says, Hi, John Andrew. Do you think Trump's policy will make America great again? I would say that Trump has much more ambition now, and he understands the political landscape in America much better than he did when he first started. So I would say, in general, Trump is going to move aggressively. And what I would also say is that when Trump came into office in 2016, the Republican Party did not welcome him. The head of the House of Representatives in America, Paul Ryan, openly criticized Trump and eventually quit and got out of the business because he didn't like Trump. There's not that kind of opposition against Trump in the Republican Party, and he's got control of the Senate, the House, and the presidency. If that's the case, I think we haven't totally got all the House seats in yet, but we will soon. If that's the case, if he doesn't move aggressively, then it's going to be a disaster. So I do think that he's going to implement his policies aggressively. All right. DLX, do you think that Trump's policies from now on will affect gold? I would say that gold is less attractive now that the uncertainty of the election is over. And I would say also people are probably more hopeful with Trump winning that the U.S. stock market's going to go up. And therefore, it's less necessary to hold gold as a contingency for disaster. I would also say that it's less likely that we're going to go to war now that Trump is coming in. And so the result of that is that there's less of a need to be in gold. Now, we still have a 25% allocation to gold, and we still haven't made our final switches in that allocation. But I'd say, so September, October, November, December. So we're going to make our changes in the next month or so, and then we'll look at gold at the time. Let's continue on with some other questions. Here's a good one from Salia. Will Trump bring more peace to the world than Biden? Absolutely, 100%. 100%. In fact, the State Department, and I would argue the Democrat Party now, is really a party of war. And that's, I believe, one of the reasons why some people decided to vote for Trump, is that it appears as though Trump is going to be anti-war in two ways. The first is he's stated that he doesn't want to start any wars, and he wants to end the wars that are currently happening. The second thing is that Trump seems to be the type of person that would rather negotiate than go to war. But I do think he will use the power of the U.S. military as a threat, and so as a deterrent, as we would say. And so if Trump uses the power of the U.S. military as a deterrent, then I think that he will be able to stop countries from acting up. Next question. Keep your questions coming. I love them, and I'm going to go through as many as I can. What is your view on S&P 500? How far will it go? Well, I think that there's still some ways for S&P 500 to go, but I do think that we are approaching the peak in net margin for companies in the U.S., particularly the large cap companies. And also, we are at a relatively high valuation for the large cap companies. So although I do think that we're going to see interest rates falling, and we're going to see basically some excitement about Trump's policies that will attract capital, I would still have some waiting in the U.S. now and ride that. But at some point in 6 to 12 months, we may hit a peak for the S&P 500. So I'm looking at that. Now, of course, if we are hitting a peak for the S&P 500, we're probably hitting a peak for the large cap companies in the S&P 500. And so maybe one strategy at this point is to be able to switch into to small caps or mid caps in America. That's another strategy that we're working on and potentially launching in 2025, is a fund that gives us the right kind of exposure to the U.S. So that's my opinion chart on S&P 500. Pitt says, hi, John Andrew, from your perspective, which asset class would be benefit from Trump's policy in the short run and long term? I think that S&P 500 probably is going to be a beneficiary. I think that if you're holding bonds right now, we should see that interest rates fall because I believe Trump is going to try to push interest rates down. And I think the Fed already is in a downward cycle. And so I think interest rates could get back down to zero. If interest rates got down to close to zero in the US, of course, that would make the value of your existing bond portfolio higher. And so I think you can argue that bonds could do well over the long term and stocks over the short term. That's my answer. Lee says, I agree. I think gold might plateau or dip given that there could be less call for wars. Yeah, I think that definitely the purpose of gold has been served. It carried us through an uncertain time. And now I would say that it's not as necessary, but we'll see. We'll see. All right, excellent questions. We've got 176 people on this call. Feel free to ask any question that you may have about the strategy or about anything related to global investing, global politics, and the like, or maybe you just want to know what's a good book to read or something like that. You can ask any question. So I'm going to switch back to my presentation and hold on, let me do that. So I want to talk a little bit more depth about the US election. So once again, Trump won. And actually, you know, one of the things that was kind of interesting is that Kamala Harris was pretty much the worst candidate that the Democrat Party had to run. She'd already failed in the Democrat primary and basically didn't do a standout job as a vice president. The Democrat Party knew that she was really their weakest candidate to run, and yet they ran her anyways. My prediction, if you recall, was that the Democrat Party would run Gavin Newsom against Trump. I was wrong about that in the sense that I thought that they couldn't go with Kamala because they weren't going to win, and they knew it, but they did go with Kamala. Now, also, my prediction was that that Kamala would win, and my reasoning for that is that the Democrats had a huge amount of control over the election when there was mail-in ballots and the like, particularly during COVID. And it really appeared like they were able to manipulate the vote in 2020. Plus, they had Google on their side. They had the media companies on their side. They had so much power behind them that I thought they could override Trump's votes, but they didn't, and they weren't able to do it this time. That was interesting. So Donald Trump won the presidential election by a large margin. He's got 312 seats versus, or electoral votes versus 226 for Kamala Harris. And before we do that, I just want to switch back for a moment and talk to you. I want to talk to you about the Electoral College. In the US, we have something called an Electoral College. In other words, the president is not elected in the US by popular vote. And there's a reason for that. Now, some people say they want to get rid of the Electoral College because they feel like it's not really a fair system. America is supposed to be a democracy, and people should be able to vote for the president. But it's important to understand, where does this electoral process come from? And basically, the thing about America is that it is not a democracy in the way that most people would think about it. It is a union of states. We call it United States. It was the states that created the federal government. And it is the states that have the control over the federal government. Ultimately, the Bill of Rights and other things, the states required to be in the Constitution to protect the states as well as their populations from abuse from the federal government. And so it's important to remember that the Electoral College is about states' votes for presidents. Now, a state would be kind of foolish if the population voted that they like this person, but then the electoral vote went to the opponent. But it happens at times. And ultimately, that electoral process, to me, it is the last chance for democracy on this earth, in the sense that if the federal government started to have huge power in the US and was forcing people to do whatever. Let's say that Trump becomes a dictator. That's what the argument was. Trump's going to be a dictator. If Trump is a dictator, well, the states have the ability to refuse what Trump is doing because it is a union of states. And so it's important. And that's just the reason why we have the Electoral College. Let's go back to the presentation. And we have Electoral College votes of 312 for Trump and 226 for Harris. But more importantly, Trump also won 50.4% of the vote versus 48% for Harris. So he not only won the Electoral College, but he also won the popular vote. That way, it is pretty clear who the winner is. Now, it looks as though Republicans have won the majority of the Senate. We now have 53 confirmed seats in the Senate, and that basically flips the Senate to the Republicans. And up until now, the Republicans only had the House, and they couldn't control the Senate. But Trump has a dream come true. He now has control of the Senate through the Republican Party. Finally, the House is not certain yet, but it's likely to end up with a Republican majority. What we can see right now is that you need 218 for a majority, and the GOP now has 214. But we do have some states that haven't reported the results yet, and those tend to be Democrat voting states. So it's possible, though unlikely, that the Democrat Party gains a majority in the House. But I would say we're probably at an 80% chance that the GOP gains a majority, because all they need is basically four more votes or four more seats in the House, and they'll have a majority. If they have a majority in the presidency, they control the Senate and the House, then there's no reason why Trump couldn't move very aggressively, and we see big changes coming out of the U.S. Now, Democrats did win in states that don't require voter ID. This is a great one that we've seen on a bunch of news stations, and if you're on Twitter, you can see it. And that is basically the states that are blue are the states that basically have been won by the Democrats. And what this chart highlights is that majority of them either require no ID at all, or they require an ID that doesn't require a photo. Now, can you imagine that in Thailand? I mean, that would just be absolutely crazy. It would be absolutely crazy. Can you imagine an election in Thailand where you just walk in to the voting area and they do not ask you for a photo ID? It would never happen in Thailand, and it wouldn't happen almost anywhere in the world. But still, some of these states are still doing that, and it's crazy. It's really ridiculous what's happening. So I see some good questions coming in. Make sure that you ask your questions, particularly about Trump and policies right now. I'm going to continue on with my presentation here. Before we get to Q&A, remember, we got the next Valuation Masterclass number 19. This boot camp starts on the 6th of January. We help finance professionals become valuation experts in months rather than years. And we have many previous attendees from FINNOMENA. And here are some, like Chachada as an example, and Tosapon, and Takon, and Jutamas, and Bunsim, and Pongsakon, and many others that have joined either who have worked with FINNOMENA or are a client of FINNOMENA. In the Valuation Masterclass Bootcamp, it's a 6-week guided but intensive online course for valuation. We have daily sessions, team support, progress tracking, and the objective is to write and present a professional valuation report by the end. So you get an extra $100 off if you use the code FINNOMENA. Just go to the QR code or valuationmasterclass.com/bootcamp, and then you can sign up there. We've also put a copy of that in the chat. So feel free to go there, and it would be great to see you at the boot camp. All right. It is now time officially to switch into Q&A. So let's do that now. I'm going to remove that from the screen, and I'm going to close that. So feel free now to ask any questions that you may have. We got about 205 people on the call, and I welcome all of your questions. So let's try to go through some of the questions. We've got about 15, 20 minutes to go through. So Das Kitty Sock says, with Trump's policy, there's likely higher inflation, but why is the DXY rising? What can be a criteria or signal that considers a tipping point? Well, remember that inflation is ultimately the main inflation protection comes from stocks, from equity. So if somebody really thought that we're going to be experiencing high inflation in the US, equity is one of the places that they would have long-term exposure. Now, also, part of why the dollar is up in particular is that people are feeling more hopeful that Donald Trump will stop the continuation of the debt. And if that starts to reverse, then that should add strength to the dollar, like it's starting to improve. So first, dollar could be up because people are buying US stocks and they're trying to combat inflation by doing so. And then the second one is they may be hopeful that the tide is turning. So, can I get some water? Thank you. So that's my opinion at this point. The question is, what can be a criteria or signal that's considered the tipping point? Well, I would say that for the dollar, if we got to a point where people didn't feel confident that Trump was going to really bring down spending, government spending. Trump is talking big about bringing down spending, but he's also reducing taxes is what he wants to do. And every time that I hear Trump talk about a policy, he's talking about allocating money to it. So we do not have good evidence that Republicans and as well as Trump are really, really not big spenders. They're just as much big spenders as the Democrats. And so I think that there can be some doubt about that. And if we see that they can't bring down costs, then that could be a tipping point for the US dollar. So Supercorn says, gold may consolidate for a while. Would you consider to reduce your portion for the next adjustment? Yes, it's possible. We'll see. There's still uncertainty getting to the final inauguration. I still think that the Democrat Party is there's so much hatred against Donald Trump. For some reason, he just brings out the worst in people. And so there's so much hatred that I think it's possible still that they can try to take him down. Would we see another assassination attempt? I hope not, but it's possible. So we'll see. But for right now, I don't make changes based upon what's happening right now. I'll reevaluate when we do the rebalancing. Till now, does the yen carry trade still potential become a problem in the near future? Yeah, I mean, the yen carry, I would say really it depends. This is a really hard one, and I can't say that I'm the expert on the yen carry trade, but what I would say is that there's more attractiveness in the dollar, which in theory has a negative impact on currencies around the world, including Thailand and including the yen. And so we could continue to see a weakening yen. And if that's the case and a stronger dollar, then if you borrow in yen and you have to pay back in yen, you're paying back in a weaker currency. So it's possible that it's a problem going into 2025. Remember, just go to valuationmasterclass.com/bootcamp, and then you can get access. And remember to use the code FINNOMENA to get the discount. Okay, I just want to highlight for those people, we got about 200 people on the call. If you've got any questions, make sure to put those questions in now. We've got a little bit more time, and I'm happy to answer those questions. Let's go to the next question, and that is, so the name of this person, I don't think that's the name of the person, but it says, Gan Long Tun. So for this comment, when do you find the correlation of each assets in the portfolio? You find correlation based on NAV, each mutual fund each day, or percent change of price of the mutual fund every day? First of all, when we do the correlation, we tend to look at the underlying ETF because we just have much more information on that. So we don't generally look at the NAV. We look at the underlying ETF because that just gives us a longer period of time to test. And we do sometimes look at daily changes. Sometimes we look at weekly changes. Sometimes we look at monthly changes. I can't give you an exact answer. And I can tell you that each of those can give very different returns. And so you could see daily returns correlations being somewhat high. And then you look at monthly and you find out it's not as high. So, and there's no exact answer as to which correlation is the right one to use. So I would say that correlation is just a guide and more information, but it cannot determine exactly what you're going to do. So hopefully that answers the question, but feel free to ask more. So let me just take a moment. If you've got any questions, we have 202 people on this call. I'm happy to answer your questions. Feel free to ask those questions now on any topic. Supercorn also says, if US dollar is strong, it will hurt emerging markets too. Definitely. I think we have a period where emerging markets still cannot outperform if we see strong US dollar. Now, at some point, we're going to see that US dollar turn. And at some point, we're going to see that the valuations of emerging markets are so low and the markets are so attractive that we'll see a switch from developed markets and the US into emerging markets. But Supercorn, you know what's holding that back? What's holding that back is that the return on equity of emerging markets is still significantly below the developed markets. Emerging markets are not producing great profit margins and ROEs. Just look at Thailand. Look at the performance of the financial performance of the companies. It's not that strong. So I would basically say that until the emerging markets can start to turn around their profitability, it's very possible that we just don't see a big recovery in the emerging markets. But if, Supercorn, you were asking me for a 3 to 5 year trade or investment, I would say emerging markets should be a good long-term place to invest. So that's my perspective on emerging markets. Remember to ask any questions. We got 224 people now on the call. I welcome any questions. It's lunch break, a little bit after lunch break, maybe your coffee break. I'm at home. My new bookshelf I've just put up there, as you can see, has lots of different books on it. Let's continue with questions that we've got. The next one comes from Salia DC. What's your view now on recession or soft landing? I think that originally my view was that we were going into recession. I still would say that there's a possibility of that in the US, but I do think that Trump is going to fire things up by trying to cut taxes, have the Fed reduce the interest rates, and set the US market on fire. And that basically means that it's probably more soft landing than recession. I haven't updated my economic expectations, but I would say that that's kind of where things are at right now. Again, we've got about 216 people on this call. Feel free to ask any question that you want. And as simple and as easy a question you may think you don't want to ask it, feel free to ask it. I'm happy to answer it. Pony Taro. Aside from the US, I think India was the most surprise market for me. Too bad I have none in my port. Yeah, I mean, India is, there's so much potential for India over the long term. So I would argue that India is a good place. And in a portfolio, definitely there's a place for India. But I also would be careful because, you know, it can get expensive at times and not necessarily perform. I had some investors come and see me yesterday, Sunday, at my home, and they basically take advantage of the deposit rates in India, which are 7 or 8%. So, yep. All right, let's continue on. Again, we got Gan Long Tun says, if I want to find correlation of each fund, what data should I use to find it? So far, I have daily NAV. So what I would do in this case is I would say you can look at the percent change in the NAV on a daily basis and then do a correlation of the percent change on a daily basis versus the percent change on the index or on what you're trying to correlate against. And so in this case, I'm correlating against equity. And so you want to look at percent change in two different funds. You don't look at the total, let's say the NAV price, you just look at the change. And going back 2 to 4 years is fine. Now, I do a rolling one because it makes a little bit more sense to me, but I would suggest that you even consider doing, instead of calculating daily change, calculate weekly change. It takes some of the volatility out that doesn't really matter on a daily basis. And if you try daily percent change and weekly percent change for the fund NAV against the fund NAV of, let's say, an equity fund, then you'll see the correlation. Now, you could do another way is that, let's say you do week on week percent change. Then you can do an average of that, let's say over a 100 days or 50 days. You could do an average to smooth things out. And then you could do that average for both of them. That's some ideas on how you can do it. If I didn't answer your question fully, just feel free to describe it more and I'll do my best. All right. Remember to ask any questions. We just got a little bit of time left. So let me get on to the next question. Next question from Supercon says, is it possible to have 0% in EU as EU may become underperformed market or recession? For me right now, I never go to 0 on the major markets because what if I'm wrong? If I'm wrong and I have 0 exposure, I've really hurting the performance. So the reason why I never go to 0 is because I have to accept that at times I could be wrong. But the bigger question that you're asking is, what if we reduce the portfolio's exposure to Europe because it's potentially going to underperform and it's potentially in a recession? Yeah, I mean, I think that Europe doesn't look very good right now. And Europeans don't seem to like Trump. And if they get in a fight with Trump, they're going to get in trouble because they already have been in, getting the benefit of the US in the Ukraine war. And Trump's trying to stop the war. And also the problem that Europe has is that they let America encourage them to cut off gas supplies from Russia. And then when America blew up, I'm assuming it was America, blew up the Nord Stream pipelines, it permanently stopped the flow of gas from those locations, from Russia into Europe. So I think that Europe is kind of in a bit of a bind, and they got to be very careful in the way that they negotiate. So yes, I do think that there is some downside for Europe right now. Smile says, how do you think about Tesla stock? Should I buy or wait? Tesla is a very expensive stock, and you've really got to be convinced that they're going to have more and more growth and more opportunities with AI and other things. I think the Tesla buyers believe that that Musk can continue to bring new innovations. And if you believe that, then maybe Tesla is a good buy right now. But for those people that are concerned about valuations and other things, then I would say it's not such a great buy right now. So it really depends on where you're coming from. If you really love the Tesla story, then you're going to be a long-term holder. Patra Win says, Trump shall support tech AI industry, particularly more than other industries, so it might have a chance of getting higher price, even its all-time high this year. Yeah, I think that generally Trump is supporting crypto and AI, and it should be that Tesla, benefits from that. But I also, I warn that Trump can change his mind pretty easily sometimes, so we have to be very careful. But in theory, tech and AI should do well. But now there's another thing to think about, and that is when it comes to tech, which has outperformed a lot over the last 5-10 years, you have to remember that pretty much all the tech companies are Democrat. People working in them voted for Democrat and voted for Kamala. That chances are that Trump will go to blows with them. And so I wouldn't count on tech doing that well over the next, let's say, 4 years of the Trump administration. Well, I think that was the last question, and I want to thank you guys all for joining. we're just about out of time. And I thank you for your interest in the all-weather strategies. And I want to say in a month, I'll be back on and we'll talk about the performance. If you have questions in between, make sure to reach out to FINNOMENA and your advisors and get as much answers as you possibly can. And meanwhile, again, thank you for listening and thanks for all your great questions. I'm going to see you in a month when we talk about the performance. Let's have an amazing end of the year. I'll be in Chiang Mai in a couple of weeks, and I hope that you have great plans for the end of the year. Have a great Monday.